watching the replay, you want to skip right to the training, go ahead and skip ahead to minute 3 of the video. We're going to get started right away with Adam, make the best use of his time and the best use of your time. I did want to, as we've been starting off these sessions with maybe a little business building tip, is I wanted to share this book with you guys. I guess it's showing backwards maybe on your screen, but it's called Story Selling. And we had this guy, Nick Nanton, actually on the Tax Pro Nation podcast last week. Very interesting concept. As you guys are going out and building your business in acquiring business clients, the power of your story and about different stories that you see with clients is an excellent way to kind of open up the possibility for new clients to do business with you. So Nick talks in this book, and I don't know, Adam, if you've seen kind of the power of story selling before, but he talks in this book that when you're telling a story, it actually activates a certain chemical in the person's brain, and it creates a bond between two people. So sometimes as tax pros, we're kind of talking at people, explaining things, and if we can turn it into a story, he just makes a great point about how powerful that is. So I thought that would be a good intro, being that I created kind of a story for this training session of an S corporation. So from the start, when it wasn't an S corporation, through a very successful over $1 million business. So we've got a lot to cover in this hour with Adam. And we're going to focus in this session. So this is the final live training session for S corporations. What's up, everybody that's showing up? Put that 1 in the box if you can hear me. Okay. All right. Let's do that. But we're going to talk in this session. We're going to focus on 2 things of when working with S corporations. Very big factor. Okay. And then the second thing we're going to cover is points of value. Be able to go through with Adam of, as this company is growing, points of value, those ways that he can distinguish his service, and he and his team can go beyond just the average service to really create the documents that we're going to go through. Adam actually hasn't even seen these documents. It's going to be a very live training. And I wanted to start off, Adam, open to it with, we had a couple right here actually in North Carolina, I believe, in the Durham area, and Carlos out in California. So if you're up for it, Adam, maybe you can address those questions to start us off and just show that we're really in dialogue with the members, and we want this program to be very actionable for you guys.
Sure. So I'll start off with this question from Randy, and try to summarize kind of what the issue is here. It's a pretty detailed scenario. Kind of highlights it as a base issue, and maybe it's partially that, but it's also kind of recognizing the loss. Had a client, he purchased an in-home care franchise for $55,000. For the territory and for a variety of reasons, did not end up actually launching the franchise. Can't really do it. A couple years later, they're at the point where the franchisor would not refund their fees, and they're really not going to do anything with it. So a couple.
And I'm not sure too. I'm not sure, Adam, if you wanted. Do you want to show your screen for this part or no?
Yes, I'll show Drake here. Sorry about that, Andy.
Sorry to cut you off there.
Yeah. Thanks for holding me accountable.
I've forgotten to click many buttons in my life, so sometimes I notice that.
So anyways, in this case, and so there's a couple of things you would want to dig in into this scenario, and it's not maybe super clear on some of the details from Randy. Is like, he says the individual client purchased an in-home care franchise. So really looking at issues: who has a franchising license? Has it been transferred to the S Corp? Is it still at the individual level? I'm going to assume for the sake of kind of what I'm walking through here this morning that it's at the S corporation level that they've set up. I'm showing it in 2017. Drake may not necessarily be the year in the scenario. And so the scenario is like 14 and 15 kind of some calendar time frames. And then even in 16 as well, potentially, or late 15. So some things to think about. One, you want to look at with the S corporation, was anything ever filed? Was it not filed because of the assumption that there was no activity? If they weren't filed, you'll want to look at the EIN letters that basically specify EIN letter and potentially the S corporation election letter that may specify when they're first looking for returns. So you just need to make sure the proper returns have been filed. Now, as far as wrapping this thing up, I just have here on the depreciation screen, you can see I assumed it was a 10-year franchise license. The franchise licenses are amortized. You should have amortized instead of straight line there. And the amortization time frame is going to be dependent on the length of the license. So if it's a 5-year license, the cost of the license is amortized over 5 years. If it's 10 years, then it's over 10 years as I have it in here. So you see there's a $55,000 cost. Property type have 1245, which can include intangible assets. On the property types, I'd say that's kind of, to just do some reading on those different types there, and there's good summaries out there. For this franchise license, since it's not going to be used, I would, basically take it off. And so you look at, is it at the end of the year? Are you really filing as of the start of the year? And when are you filing the final tax return? I would assume this would be the final tax return for this entity. So we're doing that. If you file the final tax return on a date other than 12/31/17, you just got to look at timings, because you could potentially run into late filing penalties if it was not extended and say it ended on 1/1/17. So what I'm going to do here is on 12/31/2017, going to mark it as a sale as this asset is sold. So this is how you handle these asset sales in Drake. On the sales price, basically, I'm going to have 0 because they're not receiving any sort of compensation for that license, but basically it's worthless to them. They're not, an assumption is they probably couldn't sell it to someone else. And they've come to the conclusion they're not going to do anything with it.
So similar almost to a like a worthless stock or a bad debt, where it's just you're writing it down to 0.
Yep. And then I would also put in, so initial, let's clear these out from a previous example here. Additional capital contributions. So if this is a first year and it's last year or whatever, or say they filed in a previous year and say they use personal funds to purchase that license, then they are going to basically have that $55,000 in basis there. As I have it here, I'm assuming it was from previous year, but you could do it on the current year if it's a initial and final in the same year. So let's get,
and would that basis then allow the taxpayer, Adam, to possibly take that entire loss as like an ordinary income loss?
Yeah, so it is, it is basically right now. So when you dispose of that 1245 property at no compensation received for it, it's showing it as a $55,000 ordinary income loss. And then you'll see here on the basis sheet, had 55 in stock basis and have those losses and basically end the year and are able to recognize this 55,000 in losses. So that's one way to skin the cat. I think it's a more tax advantageous way to skin that cat. The other way is you just say, all right, the S corporation, which holds the license, is no longer worth anything. And at the individual level, at that point, you'd probably be looking more at, a capital loss scenario. So I think disposing of the asset and recognizing that ordinary income is going to be the way to go. Could potentially be some tax planning here. Looking at, okay, if they're going to have this tax planning opportunity, they're going to have this $55,000 loss here for this year. Do they have other income? Is it a year to have other income? Is it a year to recognize other capital gains? Things like that. Any questions or other thoughts on that one, Andy, from your perspective, or practitioner thoughts from your end too?
Yeah, I just see here that Randy's on the training today. What's up, Randy? He says he reflected it as a long-term capital gain, or I guess maybe he means long-term capital loss. So he sort of elected the second cat skinning.
I mean, that's probably it depends on their situation, whether that's going to make a huge difference or not. So if they have capital gains, that's obviously loss is going to offset those. If they don't, then they're just going to be limited at the individual level of the 3,000 in losses against ordinary income, and carry that forward into future years.
Yeah, and I think it's a good illustration, as I know, our members are familiar with that. There's multiple ways to do things, and there's judgment calls, and not everything is, So I think that's what you're saying about like measuring, like how much tax impact would it have on the personal return? What's the risk? What's the justification? So I think that's great things to think through. I know. Carlos also had an interesting question that did you get a chance to look at that one?
Yep. So, all right, here. So Carlos's question was basically, and I've created a spreadsheet here of his scenario, and I'm just going to populate it as we go through it. So it's first year, calendar year, short year, S corporation return. Initial investment was 4,000 cash. So there's 4,000 in cash contributed. There was $45,000 worth of a truck contributed. That truck also came with $38,000 in outstanding loan. There was a car worth $7,000. Office equipment worth $6,500. And appraisal equipment worth $18,000. And so you'll see I just kind of plugged in. We know total assets minus liability is going to equal equity. And in this case, the starting equity is going to basically be their capital contribution, or their also kind of their starting basis. They may also have, depending on how this loan is structured and everything else here, they may also have some debt basis based upon that there. Other things to note, so these trucks and cars and things, if they're really being contributed over to the S corporation, should then be titled in the S corporation's name, and all the I's dotted, T's crossed there. So this, to answer the question there, I would use this as the initial starting basis, and then look at, the scenarios or details behind this debt here, and whether it's recourse, non-recourse, and kind of what they have going on for the year. They do have, in his scenario, it said total gross income of 240K roughly, and then expenses of 222,000 or 223,000. So they are going to have positive net income for the year. But you do always still want to get that initial basis correct, so they have it for the future.
Yeah, makes sense. And I'm not sure if Carlos is on here or not. I don't think he is. Make sure too, you guys, if you're having issues with your connection, to get onto a hard line as much as possible rather than a Wi-Fi. Also, if you log out and log back in, sometimes that corrects it. But I believe most people are here in the session fine. So, okay, I want to get into this scenario that I drew up. I actually invested a good amount of time into this scenario and really want to have our members get a lot out of it. Again, we're going to focus in this one, you guys, on those two items. So first of all, the problems to avoid. So problems to avoid is what we're keeping our eye out for, and I've highlighted some of the problems that come up, and so that Adam can comment on them. And then also points of value. So where does Adam, see the value in this scenario? And I'm going to try to focus this conversation, you guys, on kind of moving the story along. So this will be something we've been encouraging you guys to do, is to. There we go. Okay. So let me know if you can see that 2012 partnership tax return. But what we've been encouraging you guys to do to make sure that you're really getting ROI from this program is to look at your existing clients, if you have a database, and see which clients can you bring this training to save them money, to earn additional money for yourself. So this is going to be kind of a story of it's something that you will see, if you have business clients already, or if you're acquiring new business clients. So these people, Adam, and this is one of those, based on a true story type of deals, is 2012. Okay, started a business. You start a business, you're not sure if it's going to do well or not. You know what I mean? We've all kind of been there on that. So 2012, started it as an LLC. And with two partners, so filing as a partnership, and wanted to kind of get your comments, Adam, if possible, on, first of all, the fact that it is an LLC from the beginning, and relative to the opportunity to convert that to an S corporation later, depending on the income. Is that something that you look for, as opposed to, Adam, like a general partnership? Is that important? Do you think that's a point of value that you would bring to clients?
Yep. And a lot of times we get questions or meetings with people, and they ask, they come in, hey, I'm starting this business. I need help getting set up. Here in North Carolina, we don't truly, like, CPAs don't set up, legal entity structures with the Secretary of State, but we can give them some guidance. And I do love, for the point you raised, Andy, is the LLCs for flexibility, because if they're not sure what they're going to end up generating or how it's going to look, the LLC gives them flexibility. If there's more than one person, then they can start at the partnership route if they want, or they can go to an S corporation immediately. If it's just one sole owner, then obviously they can potentially start that LLC as a disregarded entity and report it on their personal return and keep their initial tax preparation fees low and things like that. So I do like the LLCs for the flexibility of it. So yeah, there's definitely some benefit there to that. And, in this case, depending on what they start netting on this partnership tax return, it may make sense for them to, look at doing an S election so that they don't have the FICA or self-employment tax, or whatever you want to call it, the 15.3% on their K1 income.
And so keeping in mind then that if it was a regular partnership, so no LLC, and then they elected to be an S corporation later, you don't have the same ability to backdate the election, to determine the salary levels like before the year end. All of kind of the money saving, not all of the money saving things, but a lot of the money saving things that Adam's been training on in this program are really not possible in the same way without having an LLC ahead of time. So I think that's something that kind of right off the bat, if you see companies that, hey, they could either be a Schedule C or a general partnership, or an LLC. There is some extra cost. Definitely in California, it's a little higher than here in North Carolina, but that's something to kind of keep an eye out for this startup stage. And then, like Adam said too, I had highlighted here. So there's two members, Adam, and then so I guess this net income relative to what you're saying about possibly doing an S corporation would be something that you would kind of look at, in the first year that you're doing this partnership return.
Yep. Yeah, definitely look at, assuming if they're 50-50 and those two partners or however they are, they're kind of netting over 40,000 a piece in, positive income there. And that's kind of the threshold. We typically say 30 to 40,000 in net. It's probably where your salary needs are going to come in, potentially less than what the K1 income is, and going to make sense to look at an S corporation. I'd say with someone who's already a partnership versus say a sole prop LLC, there's not as much incremental cost for shifting to an S corporation. Basically, the only thing you're adding is payroll. You're already going to have to pay for a separate partnership tax return in this scenario.
Yeah, and so definitely points of value with this startup type of client are those things that Adam's touching on. Like, hey, if I did become an S corporation, like what's my increase in my cost of my administrative fees? How transparent do I feel Adam is about telling me about that ahead of time, rather than having my tax prep costs triple without me knowing it ahead of time? So those are just some of the tips that we want to kind of have you guys pick up from the way that Adam does things. And with this one, so because the income was under 250,000, there was no balance sheet required, and this tax return actually took advantage of that, Adam, to not do any balance sheet. So that's going to be a potential problem to avoid, because we're going to see as this company grows, there's going to be some reconstruction challenges related to that. So I think that goes to your point of what you're saying in the course of, best practice would be, even if it's the balance sheet's not required, still address it.
Yep, for sure.
All right. So if you guys have, clients in your current database, partnerships, or Schedule Cs, that this kind of strategy is going to make sense for this scenario, and this story that we're leading you through of this company is going to kind of give you some insight on different problems to avoid and points of value as it grows. So here we come to 2013. There has been an S corporation election. I noticed here on the returns, we actually sourced the basis of this story from our community. So like I said, it's based on a true story. I notice here that it now says INC and not LLC. Is there any kind of potential problem to the change in those letters?
So as a question, so this is the same thing in Inc. versus an LLC, or is this a continuation of the other one?
Yeah, so same company. This is a total trick question, so I don't want to put you on the spot with it. But what happened with this company, as you can see by this amended K1, is when they went and tried to elect to be an S corporation, they actually created a new entity, and then the tax return was actually filed under the complete wrong EIN because it was on that. Yeah. So it's on the LLC EIN. And with these growing type of companies, you could see they're a small company, right? The lack of communication between the tax preparer and the clients, because you can't get a hold of them and it's like a back and forth, basically led to 2 years being filed on the completely wrong EIN. Which then had to be amended. So have you ever had the pleasure of going through that type of scenario?
Yep. I've seen wacky stuff like this, and it's kind of comes about like probably the discussion when you had the 2012 or whatever was, you need to make an S election. Person said, okay, I don't want to pay you $100 to do that. I'll go do it myself. And they end up doing something stupid. And then they've got a much more expensive mess to clean up, which I guess is good as far as fees for the tax preparer. But I'd rather they're not going to be happy about having a mess cleaned up. I'd rather focus on helping coach people or guide people as they're growing versus having to clean up a retroactive mess from people in the past.
Yeah, and that's the point. So Deb's saying, thanks for the question, Deb. Do LLCs always need to get a new EIN when they elect to be taxed as a corp? So that's the point that I'm trying to make here is no, they should have the same EIN, right? And if they don't, if they go off and get a new EIN, I mean, this was filed 2 years on the completely wrong EIN because of that miscommunication. So like we say in the training program, and like Adam and I have learned the hard way, is that we can't assume that just because we said something that people are, if they go and do it themselves or hire a different a contractor to help them with the corp setup, don't assume that that's correct. Like, you have to establish those basic information. What is the EIN for this company? Why does it now say INC instead of LLC, right? And so what happened with the scenario is actually it wasn't discovered till 2 years later, and I think it was like over $7,000 in late filing fees.
Yep.
Late filing penalties. So when it comes to points of value, then this tax preparer was actually able to get those penalties abated by filing an amended return and all that. But like Adam said, it's a big giant mess, and you want to, as much as possible, avoid those messes at the front end by having some basic information locked down. So I wanted to kind of share that joyful experience.
And shifting from the LLC is a partnership to the S corporation, really all they have to do is file a 2553 S corporation election to do that. At least in most states, shouldn't have to do much or really anything at the state level unless they have something specific. Shouldn't, as we covered, have to apply for a new EIN or anything like that.
Yeah, and I know it's a balance for people, like not wanting to form entities or offer legal advice. But sometimes if you just let somebody else do it and it's your client, and you got to maintain that good communication so that you know what has occurred. So that's definitely something you want to avoid. You can see here, Adam, highlighted, kind of the income is going. There's the arrival of line 7, compensation of officers. Is that, I guess that would be something, because that's sort of the point, the tax saving point, corp election. Does anything jump out at you about that line?
I mean, we're big advocates and proponents and of people coming to a methodology of how they get to a reasonable salary. And so just making sure they have something along those lines to back up how they got to that $27,000 figure. Yeah.
So how was that through? How was that addressed? Also wanted to highlight here. So it's still not over or at that 250,000 in sales. Balance sheet still not required. So you're not, this tax return is not addressing any of the distributions that are happening. Do you think that could potentially cause issues?
Yeah, potentially, something to look at there for sure.
And no balance sheet as well. I was going to point out that the 27,000 is only really one of the members. I also put the fee level here, $600. But only one of the, I guess you could say partners or shareholders is really working in the business. So that's only one salary, and the other shareholder already had a full-time job. So that's kind of another little wrinkle. So just keep moving along here and trying to jump out these problems to avoid for you guys, and also points of value. You come to 2014, you can see the company is now growing pretty solidly.
Yep.
So income's going up. What only thing is line 7 is now at a 0.
Yep.
Is that potentially an issue?
Yeah, potentially, and something that needs to be discussed and looked at. because they do have some risk. I think you, as a preparer, potentially, at least in our view, have some risk of filing this without some sort of salary. So it really depends on when you discover it. It could be buried there in line 8 as well. What's the line you just highlighted, Andy? Hopefully that's the case and they've done something. We have also in the past, if we feel like they need a reasonable salary, they've done nothing, it's June of the next year and they don't want to file all these late payroll tax returns and really get hammered with things. We will on occasions have them, well, maybe not the most technically correct thing to do in theory. It's kind of gets to the point, like we will file a 1099 miss from their S corporation to themselves so that they at least still pick up some of that Social Security and Medicare tax that the IRS is looking for. I'm sure not everyone takes that view or approach, but we're pretty careful and proponents of making sure people keep their noses clean on the reasonable salary side of things.
Yeah, and even I've seen it too. We had a couple situations where we could mark in our software that all the income from the K1 is self-employment income and subject to self-employment tax. So I think one of the biggest things, and let me know, Adam, if you agree, is that when things aren't done right, what are we going to do about it, and how are we going to handle it? Because I feel like some tax pros, we get into this idea of like frustration that the client didn't do it right, or another vendor didn't do it right, or even that we didn't do it right. But it's really like, okay, well, that's going to happen because it's small business and it's just part of the job. How are we going to handle it, when it doesn't go right? Would you agree with kind of that, the importance of that?
Yep, for sure. It's important to kind of be able to help navigate those scenarios and know how you're going to handle it most of the time, and then you may have some flexibility or adaptation to the specific scenario. I would add, with the reasonable salary and the thing, if they're not taking any distributions, then our position here at this firm is like they're not receiving any compensation from that business. They may not have to have a reasonable salary in that scenario, at least based upon IRS tax court cases and rulings and things like that. So, that is another factor to look at. So they may not necessarily be in trouble like they appear to be here.
Yeah, because in essence, the company can't afford to pay a reasonable salary. Yes, and if you look at line 8, you can see they started adding employees, and anybody that's started adding employees, kind of that year that you start doing that, you might zero yourself out, possibly. So I think that's a good point, is can the company really afford the salary? How does that go into the possibly getting in trouble, part of the reasonable salary conversations? I'm glad you brought that up. We can see here a really simple balance sheet. Very simple, probably possibly not correct. Looks like no distributions. So let's jump to 2015 when things start getting interesting. So you have almost doubling of the gross income. When you see, Adam, or you kind of identify, I know you guys have here at your firm, some of these companies that you're connecting with, real entrepreneurs and people that are really growing their business aggressively, and you're helping them do that. When you see a company's revenue double, is there kind of like a certain checklist or process, or like what does that indicate to you about the client, and how do you maybe treat them differently, or think about different things?
Yeah, I mean, you have to look at their growth, and there's a couple of things. Like, with their growth comes more challenges, potentially more opportunity for tax savings. So I look at, are they keeping up with quarterly estimates with the growth? Do they understand their tax liabilities? Are they minimizing their tax liabilities? So we really identify them as good potential candidates for tax planning.
Okay.
Within our project management software, at the project level, we indicate as we complete each tax return whether they have little, some, or high potential for tax planning. And that gives us a good way to, if we're strapped for time or other stuff, to really focus on those people that, may need follow-ups later on. But also having those conversations with people as we complete the tax returns to discuss, the benefits potentially, and especially this year with tax reform starting, of tax planning and just making sure everything is optimized. Other questions we have with people is like, if they jumped, doubled their top line sales, like, what's driven the growth? Does it make sense? What are their expectations for the future? So those kind of help guide planning opportunities and things like that. And then, where are they trying to go strategically? And then how has cash flow been under growth? Because a lot of times growth can really choke you from a cash flow perspective. It seems maybe a little bit counterintuitive on the surface. But you do always want to kind of take a look at that and talk with people about that and just make sure, if they have a need to borrow money or to raise money from investors in the future, that they're kind of doing the different things they need to do to be prepared for that in the most attractive shape so they can get the best terms.
Yeah, so I think that gives you guys a window into kind of a top-notch pro like Adam that's working with business owners and growing businesses. Those are not all purely tax-related thoughts and issues. I mean, it's kind of like Adam as a business owner being able to talk to another business owner and kind of open up really different areas of conversation that do more for them than just fill out the tax return. And I like the point too, Adam, about having a way to flag in your system kind of the highest priority, and most impact that you can make for clients. So if you guys as members, you're going to get busier and busier. Like Adam, I know there's not enough hours in the day. You start getting in demand. So sometimes you have to prioritize where you can make the most impact. And having a simple way to do that, whether it's in your software, whether it's in a CRM system, I think that's a great point too. I wanted to point out here, Adam, that at this point there is more net income, and we still have the issue of 0 on line 7. What kind of, at that point, to me, it's starting to say like this is an issue and a problem. How would you sort of talk to the client about that to see how you could get that solved?
Yep. I'm just trying to, we have some, I'm just trying to see if I can find one here real quick. We have some specific verbiage that we talk to people about, and basically, we tell people they need to have a methodology to back up their reasonable salary. There's up to a $5,000 fine per S corporation return that's filed without the proper things accounted for. That'll typically get people's attention. We use it as there's an additional, with our approach, we have an additional revenue opportunity there because we will do reasonable salary reports for people and charge basically $300 per report, and then give them what they need to back that up. But at some point, if someone continues to say in the past someone continued to do this, we got to be like, you got to change it or we're not going to prepare your return next year. It's where we've been. But now we won't even prepare the returns. We're at the point where we won't prepare the returns unless they have a reasonable salary, documented reasonable salary methodology. And we've lost not a lot, not as many as you'd think. We've lost some clients over that too, but they were the kind of clients that are going to continue to pull the shenanigans you're seeing on this tax return in front of us. And when we're done with your screen share, Andy, if you want, I can just show again with my screen share just kind of what a RC report, which is a tool we use that does like the reasonable salary stuff. I I don't think you secured him as a sponsor, but it could get a little bit of a plug, and maybe you can get a sponsorship after the fact. But we use that. That's how we do it for people.
Yeah, and it's a great point in terms of being able to have that communication, that rapport with the client, to have those difficult conversations in a way that is respectful, however, also firm. And I like the point that you made, Adam, which we've touched on in the program, of having kind of your spiel or your script, like not reinventing the wheel every time, because a lot of the problems that we face, in doing this kind of work is repeated problems that are very similar to before. So once we figure out a good way to do it and a good things to say that get the result, being able to kind of replicate that. And I would imagine for you having a team, that's got to be important so that everybody's not saying something different.
That's correct. And we also have we have a reasonable salary expert within our firm too that we can lean on. But yes, to your point, everyone still needs to communicate the same message. And same things with clients and potential clients.
And so the balance sheet at this point is getting a little bit more elaborate. So I want to touch on a couple of things here, but I also wanted to, so let's say that I'm this business owner and I'm saying, yeah, I understand I'm supposed to be doing a reasonable salary. We kind of fell off the wagon on it, and so what happens in this scenario is there's actually a purchase and an acquisition of another company. So that is kind of the event of the year that's sort of sucking up a lot of cash flow and is providing some level of justification to the business owner about, why payroll's not being run and stuff. And so I think for like when a company's acquiring another company, Adam, that's probably a pretty big milestone, pretty big risk. Is that something that you see fairly frequently? What other comments would you have about an S corporation acquiring another company?
Hopefully they've had discussions with me or our firm before they actually did that, and just had some assistance with business purchases or sales. And I think we've mentioned on a previous session at some level. There's asset allocation prices or purchase price allocation, and just making sure they're smart and wise about that, especially here under tax reform, because now you can basically, the acquirer can basically immediately depreciate used assets, if it makes sense for them. So it's just kind of helping guide them through that process. And so, part of it when we were on the 2014 return and you saw that growth was asking them what their goals are. And if at that point they may say, well, I may buy someone or I may do this or that. And so it's just asking a lot of questions to prevent them from stepping in it, but also to provide you with opportunities.
Yeah, and that's kind of the two-pronged approach, is prevention from stepping in it and also then maximizing client value. So to Adam's point here about, which I want to make sure everybody's catching, is when there's that purchase of the new company, was it an asset sale? Was it a stock sale? Like, what assets were named out in the purchase agreement? What is the ability to write off those assets in the first year? Versus that you have to, amortize over time. So you can see here that there's a kind of an allocation of that, right? And taking, a larger deduction on the certain assets than others. So maybe whether or not that's proper is probably beyond the scope of this particular training, because we do want to get through all these years. But in terms of writing that off in the first year and also the impact of tax reform, like Adam said, those are the things that a top level pro is going to think about, is what's the best way to use that deduction of the purchase, most strategically. So I appreciate the point on that. This line, so basically what's been happening here is, because there's not been any salary paid, Adam, doesn't mean that the shareholders are not taking any money out of the company. And so what you have is one member that's working full time, the other member not working as much, and basically kind of was taking a distribution without taking payroll. And so what the tax preparer did is end up kind of fashioning that as a loan, because there's uneven distributions between the shareholders. Is uneven distributions, Adam, and like this whole issue that we touch on in the course, in the program, of a loan to shareholder, loan from shareholder, as a way to address uneven distributions. Is that something you see, and what comments would you have on that?
Yeah, it is, something we see when I mean, I encourage people to structure things and set things up simply as they can, but sometimes we have clients that are 65-35% shareholders, and yet they get equal distributions up to, and I'm making up a figure, but say up to 300,000. And then after that, they go to 65-35. So they are eternally, carrying or increasing some sort of loan on the books to shareholders. It's something they'll have to deal with at some point when the business shuts down or is acquired or whatever. But yeah, it's kind of an ongoing thing. And, some people, we have another client that really gets just tripped up and fixated on loans to shareholders, and just how does it ever, it's the same conversation every year with the person of how they go away, what they are, what's triggering them, and just some people just don't get it. So it's just, you got to kind of figure out where the person's coming from, what their hot buttons are, and address them.
Yeah, it almost like if a tree falls in the forest type of conversation, or it's like, where does this lead to, or how, who, and so I think it seemed like from this situation, you have one shareholder working full time in the business, like addressing it should be addressed through salary, like that person's getting increased salary. But again, when things haven't been done the right way, now you're in the position of this. Would potentially, because of the uneven distributions, and you can see how this is reflected on the balance sheet, where the person not getting as much distribution, right, is now has a loan to the corporation. Person getting the more distribution, a loan from. How serious of an issue is uneven distribution in S corps, Adam? Do you think it's something that they will terminate the S corp election, and it's a big risk that way?
Yeah, potentially. I mean, the rules and regulations are that they can, basically terminate an S corporation election because of that, and then you either default to a, in this case, are we at the LLC or the Inc. here? Andy,
The Inc.
Inc.
The Inc.
And they would default to a C corporation, and potentially have double taxation and other things this year. Now, do I really see it? No, but does that mean it wouldn't be a hot mess if it played out that way? And so that's kind of the thing to think about and look at. And it kind of comes down to a lot of it. I think, in my understanding of it, is with an S corporation, you can't have two classes of stock or different things. And so that the thought process on the IRS's end is, if they're getting different dividends or distributions for their percentage of ownership, then there's something like that going on there.
Yeah, and it would certainly be a big disaster if they were turned into a C corp. I mean, the taxes would be huge. But if you can notice in these years of growth, and which I know, Adam, you've been growing your company a lot, income's doubled, right? But we also acquired a company. Okay, so that's a big cash outflow. And even a lot of times has other expenses associated with it ongoing. The taxes are not, like, estimated taxes are not being properly paid in. That's kind of like being kicked out, can kick down the road kind of thing. As well as now having to settle out these loans. So you have a lot of cash intensive things happening that are kind of perilous in a way, right? Do you see that with these growing companies, Adam, where it's, there's those cash flow issues, that need to be addressed even as part of the tax conversation each year?
Yeah, because, particularly on the tax side of things, they can get so far behind the eight ball and just kind of get stuck in that cycle of not keeping up with estimated payments and with the continuing aggressive ongoing growth, not being able to dig themselves out of that hole very easily. So it's something to look from. So that's one side of it. So that can be the tax obligation coming out of it. The other is just if they're having to invest so much in people or plant property or equipment, whatever it is, that can drain on their cash a lot too. And so that can cause challenges.
Yeah, and I think that's one of the things that you've been really effective on your messaging to clients of what your goal of your company is to maximize their post-tax cash flow, I believe is how you put it. That's different maybe than how most accountants kind of portray what they do. You feel that message resonates with this type of client?
I think so. Yeah. We've had success with it and found people that, get the messaging, understand it.
Yeah, when you're this fast forward here to 2016, we're now above 700,000 in sales, so continued growth. That's like around 40% if my math holds out. Growth again. You do see now that there is some compensation officers, so trying to get into a good scenario. I wanted to get your comments though, Adam. So 105 compensation officers, 50,000 net income. And then that 1125E, I think I have it in here. Yeah, so it's all going to the quote unquote working member. What do you think about, because it seems like maybe going too high on the salary relative to the net income. Like what do you see here that maybe is a problem or an opportunity?
Yeah, I mean, they may be paying it too high, and a lot of times when we run a reasonable salary report for people, we actually find that they can decrease their compensation and take more in the way of distributions. Now, you have to also look at the other side of that equation, is just where those distributions fall with the two partners and what are their goals and how do you balance that out. So it's a lot easier to do that when there's just one owner in the S corporation versus multiples in the distribution. So,
right, yeah, and then people are taking money out to pay their bills, their rent payment, their house payment, and that's kind of the first priority. This sort of cleanup phase is something that definitely requires some professional help. So you can see they're still carrying the same loans; those haven't been settled out, so to speak, because the company really hasn't had enough cash flow to address that. So speaking of cash flow, let's jump to 2017. We do have about 10 minutes left and also want to get to you guys' questions. Adam's going to have to be running here in a second. So $1 million, always a good, benchmark. $1 million in sales. It's probably been quite a ride for the people running this company. What's it like, Adam, to kind of be a trusted, do you really enjoy seeing people take this ride and kind of taking the ride with them?
Yeah, it's definitely rewarding to be there along with them and see how their life has changed, probably both positively and negatively, but hopefully more for the positive. But with growth like that probably comes stress to them. And again, just kind of having those, not just those tax conversations, but just connecting with them as a human being and finding out, are they looking to hire? Do they need more help? What are they doing? And are there ways you can help them? Not necessarily for compensation from your end, but potentially. But it could be things like they've outgrown the services of their real estate attorney that was doing, the real estate attorney was doing all their corporate stuff. Now they're probably at the point where they maybe need a little bit more. I'd say from the start they probably did, but they've come to the realization that they can't keep using their buddy from college that's a real estate attorney to do all their corporate law work or legal work. And so you may be at least an opportunity to connect them with someone that's going to help them better.
Yeah, and that's definitely, if you guys check out your points of value section of your program, which was posted actually yesterday, you're going to see that building your dream team and being able to be that kind of hub of connections is definitely something that Adam's emphasized in the program. Huge point of value, especially for these companies that are growing, because sometimes they do need new people, new service providers, new allies, to kind of keep leveling up what they're doing. So that's a great point. We can see here there is compensation of officers actually more moderated this year, but there's a big jump up in employee wages. So that probably does tell us, right, that they're hiring as well. Adam, as pertinent to one of the points that you made, is now we're starting to see some employee benefit programs. So maybe health insurance, that kind of stuff. Is that something that you would bring up to clients and maybe make a connection to a health insurance broker? How would you be involved in somebody that says like, hey, I want to get benefits for my employees? Is that a big deal for you?
Yeah, I mean, just kind of connecting them with the right people as appropriate, or seeing, are they having issues retaining or attracting employees? Are they doing what they need to do? In the past couple of years, it's also been a little bit different of a conversation, just because there's been the Affordable Care Act and all that stuff, but that's kind of starting to grandfather into the sunset in the future here, but still things to consider and discuss and potentially connect them with. I would also, Andy, like looking at this, and probably even back starting in the 2015 tax year. So I see nothing here on line 17 for pensions, on the page 1 of the 1120S. I see nothing for pensions, profit sharing plans, etc. So just from a tax planning perspective, just asking them if they have a desire and need to do so. It's a little easier when it's just the one shareholder. There's no other employees in that entity. But does a 401k make sense? Does a SEP plan make sense? Does a simple plan make sense? What makes sense? I'd say generally with an S corp, especially with other employees, the SEP's not going to make a lot of sense. A lot of companies will start out with a simple IRA. So basically, the company can match anywhere up to, I think, 3% of the employee's comp. If the employees make contributions, the employees can contribute up to 12 or 13,000 max. Once that's kind of been there, a company may migrate to a 401k plan, and so they can do like 18.5 or so there. Not sure on the 2018 exact figure on that. And then from there, they may migrate to a 401k with profit sharing plan, and where they can get to like a 54,000 or so contribution for the owners. But you just have to be careful, and they have to look at, okay, what's their tax savings from an owner's perspective, but also what's the obligation that they have for what they would have to contribute towards employees.
Yeah, that's really like that point, because it's something that when you're so excited about achieving the tax deferral and the savings, and hey, the owners are so happy, they're like, finally we have some money, like we've been working like dogs, and we finally, pulling off a good net income here. It looks like maybe the acquisition was successful, or whatever they're doing is working. But then you certainly don't want to run afoul of those restrictions on, hey, you have to, if you're going to have a plan for yourself as the owner, you have to look at, are the employees eligible? I mean, that's a whole thing that if you go wrong with that, I mean, that can be legal exposure and all kinds of issues. So yeah, you don't want to let that excitement kind of blind you to some of the problems that you need to avoid. So I definitely like that comment. And do you think it is something, right, Adam, that with these companies that are growing, they're starting to get more net income, they do usually ask about that, right? Like the retirement plan options.
Yep. Or if you don't ask and their business friend suggests it, based upon the conversations they've had with their CPA, it's not going to put you in a good position, or CPA or tax preparer. So you want to try to have this conversation so they can then tell their friends who are not having those conversations, so they can come over to you as well.
Yeah, I think that's a good point. And if you've worked with business clients before, you know about how that's kind of a line, and you're either on one side of the line or the other. You're either the person sharing that knowledge and getting referred, or not mentioning it and other people getting referrals. So that is good motivation, very clear motivation. You can see here then that there's significant distributions coming out, as well as that loan being settled out from the uneven distributions issue. So you can see that there's a zero balance now. This has now been settled out. And I also noticed here, just because it's the kind of thing you notice, that quite a bit more money in the bank account at the end of the year than there was the previous year.
Yep. And that's always something to watch too.
I wanted to point out, you guys, in the few minutes we've got left, on the K1, this is surprising to a lot of people. I remember the first time I saw this, I was really trying to figure out what the heck was going on, why the net income on the corporate returns not matching up with the profit and loss statement. And you can, for the S Corp, if there's Section 179 deduction, it's actually being passed through to the personal tax return as opposed to deducted on the 1120S. Once the companies are crossing, Adam, just to kind of close out this conversation and this story of this growing company, once they're crossing up to the $1 million level, maybe they're going to keep growing, 2 million, 5 million, 10 million. I know that you guys offer and have been having success with the virtual CFO and other kind of more, I guess, robust engagements or ongoing engagements. How does that conversation take place? Like, if you thought that would be a good fit to work with this type of client?
Yeah. So, I mean, it comes back to those, I think talking points I've had mentioned all along today is just asking them about goals, where they're trying to go, highlighting here. So if you go back to like page 1, Andy, so this is $1 million in revenue, if they can make another, 5%, 2%, whatever it is on their gross, and profit on their business, then that's a significant amount of change, at least in most people's book. So it's kind of looking at those either pain points or opportunities for them, to either make more money or to have a better life, and really just kind of having that conversation beyond just, tax. Usually the evolution is this tax compliance and this tax planning. And then there may be the need or desire to have, virtual CFO services or something in the consulting area. And it's just really, talking to them about ways that they will get an ROI on it and see benefit out of it, in one of their pain points. And then the price point of that becomes generally less relevant.
Yeah, more appealing. So that's definitely a huge point of value. That's really not only a point of value for the client, but that's a point of value for us as professionals to, before you start discussing fees and how much it costs and kind of playing the client's game, being a professional yourself, being proactive and saying, hey, if we were to save you 2% on $1 million, I think that's 20 grand, or be able to increase your net by 2%, that's 20 grand. By 5%, that's 50,000. So that does change kind of the pricing conversation. I know, Adam, well, actually, I don't know, but I'm pretty sure you have a busy day today. We are done with our hour. Do you have a few minutes to take a few questions, or do you need to run out?
I can take like 5 or so to hop on a couple questions.
Okay, awesome. Thank you so much. So Art has a good question here. The Section 179 is passed through and reported on the personal return. How is that reported on the 1040?
On page 2 of the 1040, basically you are going to see page 2 of that Schedule E on the 1040. You will see it broken out there. And so you're going to see the income on page 2, and you're also going to see the Section 179 deduction there as well.
Yep. So it's going to net out, Art, similar to unreimbursed partnership expenses, where it's going to go directly against the income. It's just kind of a funky little way that it's handled. So Juliet says, I'll be filing a late election for an LLC to be taxed as an S corp. What explanation should I use for the late filing for this year? Juliet, that answer is actually that's actually addressed extensively in the materials that have been posted. There's some certain language that you use, and Adam goes through that. So I would say to check out that, and we can also, if you have questions about that, ask in the Facebook group. Rita said, Adam, does IRS have a ratio for reasonable salary of lead? Not really, right?
Not really. I think that's probably a pretty big misconception out there with it, and that's not, you know, really the ratio is not what they're looking at. And practice, that's what a lot of practitioners have done in the past. They're really the thing they want to look at to determine what a reasonable salary is like how competent you are at an activity, what you're doing, and how much time you spend on it. I think are the three main things. So.
Yeah, and I like the point that you made earlier in the training too about what is the net income of the company in terms of being able to afford, without running a loss just to pay the owner payroll. So that kind of factors in as well. Cassie says, Adam, when you have a client changing from a DBA to an S corporation, should they obtain a new EIN since the number series is different for corporations?
I guess that depends on. I'm not sure. So they were a DBA and no entity at all. Is that how you interpret that, Andy?
Yeah, I believe so. And Barb actually had jumped in and said that, yeah, just that it's a sole proprietor DBA.
Yeah. So they would need to set up some sort of entity under which to do their S corporation election, whether that's an LLC or an Inc., and they would need to get a new EIN for that.
Yeah, that's kind of goes to the point too that I was trying to make at the beginning here, in terms of when the wrong EIN got filed and all that. Is if it's a partnership, i.e., not an entity, not like an LLC or a corp, if it's a sole proprietor, there's no entity, then you need to do a new formation. But when you already have an LLC, it's much simpler to elect to be taxed as an S corporation. So again, this stuff is addressed in your training program. I don't want to kind of beat you over the head with it, but just try to give you, how much that really matters when you're in a real situation. And let me see if I can pick out, Adam, one or two other questions. Don't worry, you guys. After Adam takes off, I'm going to do up to a half hour more questions with you guys. Just want to make sure we're making the best use of Adam's time as well. Okay, Adam said, it seems like the Section 179 issue raised some interest. I know it did the first time I saw it. I was like, what is going on here? What if the Section 179 deduction on the 1040 creates a loss? Is that a loss that can be carried forward? That's a question from Randy.
Yes, I believe so. So if the 179, to your point, cannot create a loss or go beyond zero, and that would be carried forward, and there would be benefit for that shareholder in the future.
Yeah, and also you guys, I'll post these documents that I created. I should be able to post them, and you can always too play around in your tax software. It's really helpful to see how your software, where the inputs are and all that. Every software is different, but then to look at the forms and kind of be able to see how things are working on that. I think that's basically what we have. I'm hoping that since there's not a ton of questions, that the training was clear, that it was impactful, that it's helping you guys. We really want to finish the training really strong for you guys. After this, we have LLCs coming up. So this is the last week of S corps. S corps and LLCs are definitely, you'll see a lot of them. Yeah, Adam sees a lot of them. They're just all over the place. So these are really things that you will see in your real life. And with that being said, Adam, I know you had mentioned maybe showing something else on your screen, or did you want to do that, or is now a good time to for you to sign off? Totally your call.
Yeah, I can. Let me see here. Get that.
Yeah, and Deb pointed out too, Adam. I use the Drake Export K1 tool to see how K1 info flows to the independent or the individual return. It's very helpful.
Yep. So this is just our RC report that we do reasonable salary reports with. So it's a tool on the web. I don't know. I think our annual subscription is like $1,000 for it. Go through. We have a call with the taxpayer, and basically this is going to demonstrate the activities that someone does, and then as we get further along, it'll demonstrate basically, all right, so you do some janitorial, and so it gets really detailed. Janitorial and custodial work. Are you an average or above average or below average? How much of your time do you spend on that? What's the wage and compensation? And so it goes through and calculates the annual compensation for these different activities. Usually the highest amounts can be for whatever your actual trade is.
That's cool.
And then goes through and generates a report, and then it actually includes here, like, let's see if this comes with it. Yeah, just comes up with some language for corporate minutes and other stuff that they can incorporate. So this is what we use, because basically this tool, at least it's our belief, by using this methodology of activities, amount of time, and proficiency, that it will meet the IRS standards and needs to have a defensible, reasonable salary. And we probably did, if I do the math on it, I don't know, the first year we did this, we probably did, I don't know, a lot. Last year, I think, looking at it, we probably did 30 to 50 reasonable salary reports at $200 to $300 a pop at that point.
Nice. That's a nice little source of revenue and source of value. The value generates the revenue. So I think that's something that Adam's really been showing you and us how to make that connection. And that's just another tool that you can kind of keep in mind. And even if you're not using that specific tool, seeing the rigor of how that's done and how it's thought through, I know is kind of opening people's minds. And I hope it's just making you happy that you invested in the program. We really want you to get a lot out of the program, and hopefully you are. So, Adam, thank you so much for investing your time to be here today on Friday. Hope the rest of your day goes great. And I'll take the questions from here and be talking to you soon.
Okay, thank you.
Thank you. Hey, guys. All right, I try to make the program as much as possible, you guys, something that I would want myself. That's usually my tool or my measuring stick of whether we're doing something that's worthwhile for our members is, would I buy this? Would I want to have this? And I know, when I was kind of struggling through some of these returns back in the day, when I first started getting into doing business returns, I would have paid a lot to be able to look over a highly experienced CPA's shoulder like Adam. Has been so generous with his time, with his expertise, and the guy just has a packed schedule, tons of clients, tons of things going on. But I really hope you guys are getting a lot out of it. I hope you're putting it to use as well, because remember, the S Corporation extension deadline is September 15th. So there's business out there. I hope you guys are getting out in the community, getting to networking events, getting into Facebook groups, being able to interact with real potential clients, and feeling more confident that if you get these kind of returns, hey, it's not the first time that you've seen that 179 deduction issue with the K1. It's not the first time you've seen uneven distributions from an S corporation and how to think through that. Okay. So a lot of times if some of this, is not new to you guys, and some of you guys have already dealt with a lot of these issues, hopefully it's still helpful. But some of this is new information to you. So just if it feels a little bit like I don't understand everything about it, that's fine. That's normal. That is reality. But at the same time, once you've seen it once, you are light years ahead of never having seen it. All right. So I do want to go through some questions, you guys, to finish out the session. If you guys have to cut out early, not early, but on time, you tuned in for Adam's part of it, that's totally cool. I'm not going to take it personally. I do want to make sure, though, that we address any questions that you have. I also want to show you real quick the new materials that have been posted, because we now are going to have, I believe by the end of the day, by the end of today, all of the S Corporation materials will be posted. So you'll have a full S Corp module, and that's really important because there's a lot of S Corps out there. So it's really going to be impactful for you. I think if you're going to invest the most time into one or two sections, it's got to be S corporations and LLCs. Yes, there are specialty areas and C corps. Yes, Schedule C's. Schedule C is also great. But if you're really looking to increase your income, increase your value, mastering those S corporations and LLCs, and being that they also go together a lot, they're often the same thing, is going to be a great investment of your time. So we want to make sure with these final two modules that we really go all out for you guys. All right, so I'm going to show you that stuff. Let me actually do that just because before I forget. Let me do that right now, if you don't mind, just to make sure everybody's familiar. And then after that, if you're good with it, then I'll run through the remainder of the questions, just make sure everybody is feeling good as we head into the weekend. Wanted to really just, again, thank you guys too for being patient with me, not being able to attend last week's training session, and then also taking a 1 week break. I really feel a lot of commitment to the program and to you guys as members. So it's actually, it's really, I don't like missing sessions, or I want to make sure that we fulfill every single thing and more that you're expecting. That's the only possible, that's the only thing that's going to be acceptable to me. At the same time, it really feels great to be in a community of members where you guys are good to us. You're patient with us when we're figuring things out, and that's the same way that we want to be with you guys. So let me go ahead and show this screen to you. Linda said I need a mural on the wall. That's funny. I don't know what it would be on the mural. That's the only thing. So if you have any good ideas, or you're just a talented artist and you want to draw a mural for me, that would actually be amazing. So this is the materials, or these are the materials that were posted. S Corporation textbook, problems to avoid, extremely important. Lot of problems that can come up with S corporations, as you even saw in this training. Really would encourage you guys to dig into this. This I think is what is to me, if I was just starting out doing this kind of work, especially, really valuable to avoid as many problems as you can. That's a big part of being successful, is just avoiding those pain points as much as you can. So definitely dive into that. And then right along with that, you have your points of value. Sometimes the points of value are as simple as not screwing everything up, so that is also a great point of value. And that's why points of value and problems to avoid go together in our trainings. So we offer those kind of in the same week as much as possible, so you can really do both. You want to not mess up, but then you want to just go above and beyond and creating that value. Those are two, I think, really valuable chapters for you guys. Hoping they're valuable. You're also going to have then, moving down the line here, you're going to have your live training, which is going to be posted. Jeff should be able to post that today, and then I'll also post a to-do activity there. So other than that, you've got all your videos. You got a ton of stuff here in this S Corporation module. If you find that there's other resources that would be helpful to you, maybe something that was mentioned that you think that we should post or we should address, of course, let us know. Let us know in the Facebook group. Is kind of been a really good place for us to interact, just because we get the input from other members and everybody helping each other out. Deb said, I see 2 points of value, same or different. Yeah, it's actually just an accidental repost by me. So I'm going to go ahead and delete that second one. It's going to be the same thing. it's going to be the same document. So sometimes with our system, when I upload it, I can't tell if it's uploaded, and so I'll just go ahead and delete that second one. I do want to address the other questions, you guys, that we have related to the training session. And, obviously, if you have any other questions from, related to your course materials or anything like that, of course, feel free to let us know. So Rita says, what about the reasonable salary tool that Adam presented? Yeah, definitely. I'll make a note right now. See, I'm making a note using this pen to post that, Rita, and Adam's always, we're joking around with some of the tools that we teach on of trying to get some kind of sponsorship from the places. So if you guys, if you mentioned like you signed up for it or something, you should put who referred you, Pronto Tax School, we're not going to be mad at that. Just an idea, but no pressure either way. Jose, I definitely want to get to your question. Jose V. Rios, what's going on? Thank you so much, Jose, for being here today. Jose, I did see your question, and I want to address that right now. Jose had a good question of, so C corporation and the next year file as an S corporation. Yeah, that happens all the time. And if you think about it, sometimes it makes sense to do exactly that, Jose, because let's say in the first year, the shareholders are not really pulling out the profits. Say they're like trying to bank up money in the company to save to invest the next year. By using a C corporation in the early year, you are just paying now it's a flat 21% rate, right, for the corporation profits. And because you're not getting the money out, you're leaving the money in, you are not getting taxed again as a C corporation. So that's actually a really smart strategy. I'm really glad you brought that up. If you want us to kind of tease that out and show you a little bit more about how that works, feel free to let me know in the Facebook group. But really good point. And how would you turn from a C corporation to an S corporation, right? It's just a matter of filing Form 2553. So we have multiple trainings within the program about how to do that, and you keep the same EIN. It's a pretty simple process. So certainly, Jose, that's something that would commonly happen, C corporation to an S corporation. And hopefully that answers your question, as well as give you some other tips when you see clients are maybe in that situation or considering that. Keep in mind that with C corporation, whether you're going to get hit with double taxation from pulling out the money, so distributing the profits, is a key consideration of what's your tax cost and what's the best entity for you. So for some people, we have a mix of people in the program. Like for some people, I don't want to be like talking down to you guys or thinking that you don't know this stuff, because I know you do. It hopefully still can be a refresher. But for newer people, when you're thinking, what's the right entity type? Is a C corporation a good entity? That key question of how much double taxation is going to happen because of the shareholder taking out that profit is got to be a major question that you consider. Okay. Question from Jose as well, follow-up question really. If you forget to make the election, can you file as and I think he was going to say file as an S corporation. So yes, you can, and that's that late election. So that's why it's so important. We've addressed it multiple times in the training, you guys, is how to make a late election for an S corporation, because say it wasn't properly filed, or say it wasn't filed at all, say it was rejected, so that you tried to apply and it wasn't accepted. The ability to get it backdated can really make a difference depending on the level of profits of the company, depending on how much dividends have come out. So yes, you can do a late election, and they're pretty generous in the time frame on it. So make sure, Jose, to check out the trainings that we have in the program that address that, because it's really important. Margarita, how are you, Margarita? Good to see you here. Thank you for attending. Has a client that started an S corp but no activity. That's actually quite common. I believe, I don't know the source of this statistic. Sometimes I just say statistics and I don't know what the sources are, which I don't think is like academically correct or whatever, but 35% of businesses never actually get a single customer. So you have a lot of businesses that they started an LLC, they started an S corporation, they went on to LegalZoom in the middle of the night and formed something. I've done that myself numerous times, so we all could relate, right? It's no judgment. But then you don't actually get the business off the ground. When you have an entity, when you have an LLC, when you have an S corporation, especially with an S corporation, Margarita, yes, you do need to file all zeros. You do need to file a return, even if there's no income. It's not like individual filing where there's an income threshold below which you don't need to file. If you have an S corporation, you need to file a return, or else you're going to get crushed with non-filing penalties. Really hit hard. It's $195 per shareholder per month that it's late. So just make sure you file that return. Sometimes it feels kind of silly filing an all zeros return, but to be honest with you, it's actually an opportunity area, especially if you're newer to filing S corporations, because a lot of people will have those late filing penalties. They come in like, I didn't know, or they call you, I didn't know I had to file. Now I have this big letter with this $7,000 penalty. Late filing penalty, and that's going to be a major point of value to you guys is penalty abatement. There's a first-time late filing penalty abatement that is a huge deal for S corporation clients. The first time they file late, it's really easy to get the abatement too. You can just contact the IRS. You need to have a 2848, or if you're not an EA or a CPA, you can have the client there with you to clear and say the right things. But you request a first-time penalty abatement, first time it's late, you get that penalty wiped off and taken out immediately. That's going to make you look like a complete hero. When they go from $5,000 penalty, a lot of times from a company that they didn't even earn a single dollar. So that does not feel good. When you take that pain away, you get that penalty abated. Or even like the scenario that Randy said about the taxpayer that became ill after buying a business and didn't file maybe on time. The fact that that person was ill, maybe that's a reasonable cause abatement of the penalty, of the late filing penalty, especially if it's a serious illness. So being an expert on penalty abatement, maybe becoming an EA to be able to do that kind of work, big point of value. All right, Chanaka said, Andy, you mentioned before there are people out there that will review returns on a freelance basis. Where do we find them again? You can find, there's a few different places, but the place that I've looked at, and I have a video in your guys' program about it, is called Upwork.com, UPWORK.com. That's actually a great website to just be familiar with for anything you need. It's really, really cool website. You got people from all over the world, really talented people. They have a great system of kind of approving bids and all these reviews where you can see how much work the person's done, how much they've earned, what their reviews are, so you feel more confident in working with people. And I would mention too on that, Chanaka, that if you're going to have people outside of your organization reviewing returns or reviewing sensitive information, you do need to make sure that you have that in an engagement letter or something that the client is aware of that, because you don't want to have a problem with just disclosing taxpayer information in an unauthorized way. So maybe I'm going to put that a note as well. And then there's even like overseas outsourced places that do tax returns and often do corporate returns. But again, if you're going to do that, a lot of people do that and don't tell anybody and don't do it right. Don't tell the client. I would really encourage you ethically. There's so many security issues nowadays with people's data. You have to do that correctly, which includes getting a disclosure signed and letting the client know about that. So I'm going to make a note to maybe put a resource for you guys on how you would get that kind of disclosure if you want to start working with an outsourced CPA or tax preparer that can help you. I definitely think it's a good idea to have that on your team, and also using the Facebook group, even getting into other groups in Facebook, LinkedIn, you'd be surprised people are willing to share their expertise. If you are also willing to give to the community, that's a big thing. Don't forget, it's not just taking, it's giving. So you guys have been doing a great job of that in the Facebook group, and it's really helpful. I know Adam himself is involved with at least one group of other CPAs that they're able to network and help each other. All right, Deb made her usual great points of using the Drake Export K1 tool. That's awesome. I just got a few minutes here. Like I said, though, I want to make sure you guys have these questions answered. Juliet, filing a late election for LLC to be taxed as an S corp. What explanation should I use? Yeah, I didn't mean to, honestly. I felt a little bad. I didn't mean to cut off your question there, but I just know that Adam's addressed that in the training. And there's specific language. I believe it's IRC 201331, I think, and there's specific language that we give you even in the program, and I'll also make a note to try to add that to the tools and resources, maybe add that language for you. And that's what you put on the 2553 to get it accepted properly as a late election, which is a major point of value because that happens a lot. So if you want to build yourself as a valuable S Corp expert, knowing how to do late elections is a great area to focus on. Tiffany, hey Tiffany. Tiffany says, I find many S Corps are California LLCs filing as S Corps, so they're really not a corporation. And they forgot when the EIN is applied for if the LLC was one of the options. Yeah, that does happen. And that's sometimes, especially with a new client, if the client is just not sure like what they filed on the EIN or what. The one thing I would point out, Tiffany, is that the EIN is going to be adjusted on the IRS side based on the 2553, as long as you get that to go through properly. So you kind of adjust the EIN record on the IRS side by properly filing the 2553. So when you have, it's this LLC, right? It's this EIN. Here's the 2553 electing to be taxed as an S corporation. The IRS should make that adjustment on their side. And that way, for instance, when you're filing an extension or when you're e-filing the actual tax return, it doesn't bounce back saying, hey, this doesn't match up. Like this, we have this as a partnership and now you're filing an S corporation. So the IRS should be able to adjust that based on the 2553 being properly processed. Yeah, Rita made a really good point of what happens in California with, say, the LLC that wasn't properly filed that I talked about in this example, is you then get hit with the $800 a year for the LLC is not properly closed, and they won't even let you close the LLC until all those payments are made. So now you're 3 years down the line, 3 times $800, $2,400, plus all kinds of late filing. So just becomes big mess. That's why we really try to go all out in the problems to avoid section, because there's some hard-learned lessons, let's say, that we want you guys to benefit from. Yeah, Rita said how to close a corporation. That's actually a great point of value. If I can add that, because that's really good. And maybe too, Rita, if you have a checklist or something that you use to kind of make sure it's properly closed down, that is really would be valuable. Jim had a question here. California legal precedents in an April case sets precedent that most 1099 contractors should be reclassified as W-2 employees. Any info on that? That's actually new information to me, Jim. I don't doubt it at all. There's many, and even some of the things that I posted in the Facebook group about how a lot of companies are trying to change their W-2 workers to 1099 workers. The taxing authorities are not able to as easily collect the tax from self-employed people, from 1099 freelancers. So they certainly have an interest in people being classified as a W-2 employee. It doesn't surprise me at all. Maybe if you're up for it, Jim, you could post a link in the Facebook group to that case. I'm actually not familiar with that, but like I said, it would be good to know, and it is something that I know state of California particularly looks at. All right, so I've got an hour and a half that's been invested here, so I'm gonna, out of respect for everybody's time, I'm gonna take a few more questions. I think we got through most of it. If you have additional questions after these last few minutes, then certainly let us know in the Facebook group. And but I have a few more questions that are coming in now. So Jim, corporate attorney friend, helpful. Good job. That's in the points things that we mentioned is having people in your network that you can connect your clients with that share helpful information like this with you. You can do individual tax returns on that island and just be with these working with business owners is not like that. You got to be connected to other people, other experts. That's what we want to give you, this community here. But do it on your own too. Develop that in your local community, just like Jim is with the corporate attorney friend. So he says corporate attorney brought this up, the court case he's talking about. There are many who are really independent contractors. Yeah, I would not doubt it at all. You know, there's very, very many misclassified contractors around. It's kind of tough to see what they really are going to do about that because it's such a large scale issue. But I think, Jim, that you're bringing up a really good point, and it's so sometimes it does come out like you can kind of like report your employer if you feel that you're not being properly classified. Sometimes that happens, and sometimes there's other things that happen that are negative to business owners. So you definitely want to kind of be familiar with that conversation that Jim is bringing up. Cassie says, Andy, I just had a situation this week with a previous software vendor who had passed off their software as their own creation, but the actual creator but it was resolved with an email stating that I agree to their terms. So I think Cassie's mentioning there kind of the information sharing part of it, right? So when you're using outsourced vendors or you have agreements with tax software companies that maybe the software company is holding a copy of the return, there's some really severe penalties and unpleasant things that can happen when you're sharing tax information with unauthorized parties. So if a software company discovers that that's happening and they want to kind of, button that up, then they may, request a signed agreement or address that. Question about the late election. I know the language on the top, but there's a box for further explanation. And we're going to give you the language to put or a template, Juliet, of the language to put in the further explanation, and it's pretty straightforward. It's basically saying that there was no tax returns filed that are contrary to the S corp election. So, for instance, if it was a single member LLC, the Schedule C was not filed, right? So because that would be contrary to what you're trying to do now. None of the shareholders filed their own personal returns with something contrary to the S corp election. So I'll make sure, Juliet, to post that to your tools and resources so that you have that. And of course, use it as a guide, customize it to your exact situation. But that's kind of the basics of it, is making sure that there are not other tax returns that are filed where the income was reported differently than you're now asking for with the late election, if that makes any sense. And then Benjamin gave me a nice, easy question. Hey, Benjamin, to finish the session with, which is name of the book that you talked about at the beginning of this broadcast. That's what I like. Nice, easy questions. right here is backwards. So this is a little plug for these guys. Really enjoyed interviewing Nick. Actually saw him speak too at the Chauncey Hutters seminar in Orlando. Amazing. Just this guy's a very dynamic individual. And I think for story selling, you guys could really benefit from this, as well as your clients. Like when you're talking to business clients, maybe this is a nice gift for them. He even has, I think, a free version online. The PDF, I think, he's giving away for free. So yeah, highly recommend it. I haven't read the whole thing yet, but I'm really getting a lot out of it. So check it out if you want to. All right, guys. That's what I had. I like to try to stick to the hour and a half as close as possible, just because I know everybody has a lot going on. If you have any other questions, anything else to add, there was a couple of great things that were brought up, like Jim's thing about the court case, anything else that was brought up. Please help us make it a great community and a great program by, if you have something to give, post it in the Facebook group. You know, you guys add value too. You're creating a lot of the value of the program for your fellow members. So I just want you to know we appreciate that. And we just want to finish the program strong. We got 3 more weeks of live training after that. We're going to be getting into LLCs, which is a huge deal. Excited about that. We're going to be talking about real estate, LLCs, partnership, taxes. So Nancy Ellis actually has a great scenario that we're going to be able to help her with. So got some good stuff ahead. Hopefully we've got some good stuff accomplished as well so far. And just be talking to you soon. Have a great Friday. Have a great weekend. Thank you, guys. Appreciate you.